If you're currently in your 20s or 30s and want to have a happy retirement, as far away as it may appear, you may not have many alternatives, but one of the greatest is to start saving early. It goes without saying that a large amount of wealth is required to live a pleasant life. And one of the most effective ways to do so, particularly for the middle class, is to invest their earnings. You see, if you start investing early, you will be much wealthier. Here's an excellent example. Suppose you decide to begin investing $500 each month and get an 8% investment return. If you begin investing at the age of 25 and continue until the age of 60, you will only have $2.16 million in retirement. However, if you begin investing at 40 rather than 25, you will only have $341,000. Of course, this simple example is nothing new, and it is based on an investment generating an 8% compounding investment every year without taking inflation into account. But, as I previously stated, this is nothing new, and I'm sure you've heard it before. However, for the vast majority of individuals, this is still the smartest way to accumulate money and guarantee you have a healthy reserve to spend in your hard times. In short, starting early increases your chances of success. For today's video, we'll talk about some of the key assets and investing decisions you can take while you're young. Let's get started, shall we? Number 1, index funds. Stocks are among the finest investments you can invest in before the age of 40. While the risks are significant, the profits are one of the highest. You have plenty of time to make and learn from errors when you begin your financial path, but you should always make wise, measured decisions. Based on the S&P 500 index as a reference, stocks have an average rate of return of 10%. The fact is that hardly many investments will provide such a high rate of return. Consider including bonds in your index fund portfolio as you establish it. Bonds offer the lowest return rate, but they are the most secure. You must guarantee that your portfolio contains between 10 and 20% weighted bonds. This increases the security of your investment. You might also add the percentage and change it based on your risk tolerance. Crypto index funds were recently established. While they have not been thoroughly tested, they appear to be highly promising. The present return rates vary from 10 to 15%, which is rather substantial. However, when the return rate rises, so does the danger. Index funds feature cheap costs, which is a significant advantage. The higher the returns, the smaller the fees. Aside from diversity, another advantage of index funds is that many of them have minimal fees. Investment costs will quickly lower your profits, so avoid them as much as possible. When purchasing index funds, make careful to consider the tax implications. Number 2, growth stocks and dividend stocks. We have made it quite obvious that being in your 20s and 30s is an excellent moment to make risky bets, since you still have a chance to recover if you lose money. So investing in stocks is a great way to put some of your money into something like a high-risk, high-reward business. Growth stocks are simply those that are predicted to expand at a much faster rate than the average industry. These stocks produce higher long-term positive cash flows and revenues than their counterparts. Dividend stocks, in contrast, are often equities of financially solid and established corporations, implying that their share prices are less volatile than growth stocks. Dividend equities should be included in your portfolio from the beginning. They give potential to receive a regular income over a long period of time, providing the firms continue to operate effectively. Number 3, rates. Real estate investment trusts. Real estate is rarely a bad investment. Real estate is one of the ideal investments for a variety of reasons. For starters, there is virtually always a housing shortage, and real estate assets almost always grow in value. Buying your own house is the first step in real estate investment. Owning a home lowers your monthly expenditures such as rent. After acquiring your own house, you might consider developing additional business properties. These might include multifamily dwellings, townhouses, offices, and other assets. However, if you are unable to participate directly in the real estate market, you have alternative possibilities. You may spend as little as $500 on numerous crowdsourcing platforms. The money contributed would then be consolidated with the contributions of other investors and invested in real estate projects. Number 4, ETFs, exchange-traded funds. Let's take a look at ETFs, which are comparable to the index funds we discussed before. ETFs are similar to index funds in that they are baskets of securities comprising numerous assets such as stocks, bonds, and gold. They trade similarly to stocks in that investors may either buy or sell shares on an exchange. Their adaptability makes them ideal instruments for investing in large market indexes like the S&P 500, as well as sectors like tech or healthcare, and even subsectors like social media or automation. ETFs include the Schwab US Large Cap ETF, iShares Global Clean Energy ETF, and the Global X Robotics and Artificial Intelligence ETF. Let me know in the comments if you have any other questions about investing. Let's return to the video. Number 5, education. According to statistics, your 20s are the optimum age to study. According to studies, your 20s and early 30s are the best time to learn new things. As a result, now may be the greatest time to earn that extra degree. Education is crucial since it may help you succeed in your work. However, you must recognize that not all knowledge or learning is beneficial. Be cautious because some learning might be classified as a hobby and so cannot be commercialized. If you want to invest in education, begin by looking for occupations that you are familiar with and that can lead to success. This might also be an excellent opportunity to increase your financial literacy. Number 6, starting a business. Invest in a new business while you're still young. Why? The potential profits from a business are limitless. You will be able to earn as much as you want, with an infinite return on investment. A startup business is also another investment you must make in your 20s. The potential for spectacular ROI is enormous. Even if it isn't the next Amazon, investing in a firm when it is still early can yield great results. You don't have to create your own business. You may invest it in other people's enterprises in return for stock in theirs. You could, for example, be an angel investor, which is a terrific alternative if you know the entrepreneur. Your investment might take the form of a convertible note, which means it could become a loan if certain requirements are met. The third option is to use crowdsourcing. There are several crowdfunding platforms with fantastic companies with a lot of promise. Before investing in a firm, make sure you thoroughly research the founder and grasp the company's history. Choose firms with a fascinating history and founders that have education, experience, or training in the business field. Working with a venture capital fund is another option. You may start as an accredited investor and work your way up to being a venture capitalist. These funds, however, have a minimum investment amount and strict eligibility requirements. Number 7, commodities. A commodity is an economic asset, generally a resource, that has complete or significant fungibility. That is, the market accepts instances of the product as comparable or nearly so, regardless of who generated them. There are various options for investing in this. The initial step is to buy various amounts of tangible raw materials, such as precious metals. Investors can also invest in futures contracts or ETPs, exchange-traded products, that directly follow a certain commodities index. These are highly volatile and complex investments that should only be undertaken by expert investors. Mutual funds that participate in commodity-related businesses are another option to obtain exposure to commodities. An oil and gas fund, for example, might invest in equities issued by firms involved in energy exploration, refining, storage, and distribution. The benefits of commodities investment include portfolio diversity, possible returns, and an inflation hedge. Furthermore, commodities have performed the best during inflationary periods, making them one of the finest investments to buy. Number 8, annuities. An annuity is a contract between you and the insurance company where the firm agrees to provide you monthly payments either now or in the future. An annuity can be purchased with a single payment or a series of payments known as premiums. Some annuity arrangements allow you to save for retirement. Others can help you transform your money into a retirement income stream. Others, though, do both. You have a delayed annuity if you utilize an annuity as a savings plan and the insurance company extends your payout to the future. If, on the contrary, you utilize the annuity to generate retirement income and your payments begin immediately, you have an instant annuity. Fixed and variable annuities are the two most popular types of annuities. An indexed annuity, also known as an equity indexed annuity or a fixed index annuity, is another type of hybrid. Annuities are frequently considered by investors when planning for retirement. Therefore, it is important to understand them. They are also frequently offered as tax-deferred savings vehicles. Annuities, on the other hand, include a variety of costs and expenditures, including surrender charges, mortality, and expense risk charges, and administration fees. Annuities can potentially carry significant commissions of up to 7% or more. Number 9, Treasury Bills. Treasury bills are essential assets for all investors, regardless of age. There is no better time to invest in Treasury bills than while you are young. Treasury bills are short-term government-guaranteed debt instruments used to fund government spending and manage the money supply. Treasury notes are issued in 3 maturities: 90 days, 182 days, and 364 days. Tuition, housing, and even professional tests are all expenditures that must be paid. You may easily invest your cash in Treasury bills and cash out once the bills are due. This falls under the asset and liability matching finance idea, which includes acquiring an asset to finance the payment of a future liability. Unlike other investing alternatives, Treasury bills are completely risk-free. Therefore, your profits are assured. Furthermore, the returns are rather good, so why not invest in them? Number 10, Cryptocurrencies and initial coin offerings. Only lately have cryptocurrencies and initial coin offerings, or ICOs, piqued the curiosity of traditional Main Street investors. With billions of dollars generated in ICO financings and over 1,000 distinct cryptocurrency presently accessible, these volatile marketplaces are appealing to investors. Most ordinary investors also struggle to make sense of these sophisticated investment products and identify their risk levels. But we do know that they have extremely high returns. The potential profit might vary from 12 to 200%. Some ICOs have done exceptionally well. The OTA, for example, received a 13,000-fold return on investment. That is, if you had invested $1 when it was still available, you would have made $13,000. So there you have it. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button And also, don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching! Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.